The US stock market has been rallying violently off its recent lows, but this comes right after the stock market printed some of the most oversold conditions that we had seen since 2020. A market relief rally is almost inevitable following these kinds of extreme oversold conditions. Even in February of 2020, with a pandemic spreading and global economies shutting down, the stock market rallied by 10% following this extreme oversold reading. The million-dollar question now is whether the stock market will show enough strength to undo the damage that it did during this sell-off, where the index broke down below all of its key moving averages, along with some very important levels of technical support. As traders, we cannot have the same approach here as we had in all of these recoveries throughout 2024. In all of these cases, it was pretty likely that the index would recover back to all-time highs. Now that the market has broken down below these structures, we have to consider the possibility that sellers could take control of this market. I'm going to go through exactly what we're watching on this bounce that is influencing our positioning at Bravos Research, and it comes down to watching three big risk factors that are at play in today's market. The first one is going to determine the depth of the correction that we should be expecting, and that is the risk of a recession. We've been seeing recession headlines left and right since the beginning of the year, and the most efficient way to assess whether all of these fears are justified is by looking at the bond market. These can give us a much deeper understanding of what is truly happening in financial markets, and not simply react to the news headlines that we're seeing from media outlets. This is a chart of US government bond yields, and as you can see, bond yields are currently at the exact same level they were at in late 2022. This means that we've been in an environment with relatively stable economic condition, at least when it comes to financial markets. We haven't seen big jumps in bond yields like we had in early 2022 as a result of hot inflation, and we also haven't seen significant declines in bond yields like we did in 2020 as a result of a recession. Over the last few months, bond yields have been pretty much flat, not reflecting major recession concerns from bond investors. If we rewind to 2008, for instance, we see that in the months heading into the great financial crisis, bond yields were moving aggressively lower. You could say they broke down below an uptrend line here just a few months before the start of the recession. The same thing goes for the 2001 recession. Bond yields were moving down in the few months heading into the recession. Today, that's definitely not the picture that the bond market is painting. If bond yields are staying at elevated levels, it means that growth expectations are staying quite resilient right now. And this is being confirmed by what we're seeing from government data. This is a chart, for example, showing us the total number of employees in the US economy, and it's been continuing to grow quite steadily over the last few months. Again, heading into and during economic recessions, you typically see the job market roll over, and that's where things get a lot more dangerous for the S&P 500's performance, for instance. In fact, if we add the S&P 500 on top, we see the performance of the stock market is generally tied to the strength of the job market. A deterioration in the job market could make us a lot more worried about a much more significant correction in the S&P 500, just like we had in 2001 and in 2008. But the truth is, we're not seeing evidence of that right now. And stock market corrections that occur outside of economic recessions are typically fantastic opportunities for investors to buy the dip with a 6 to 12 month horizon. So yes, the stock market is at a discount right now, and given we don't believe a recession will happen in 2025, we think by the end of this year, this will have proven to be a big buying opportunity, with stocks likely ending up much higher than the previous all-time high. So naturally, we want to be coming out of this correction with a higher allocation to stocks than we had going into it. However, in the short term, let's say over the next 1 to 3 months, that's another story. While the current sell-off might not be driven by a real threat of a recession, there is a justified explanation for this volatility, which brings us to the second big risk that we need to assess in this video, and that is the current administration's tariff policy. As we've shown in recent videos, uncertainty on economic policy has spiked to the highest level since the COVID pandemic. Now, of course, eventually this is going to come back down, again making this a buying opportunity for stocks. But there's absolutely no guarantee that we can't even see additional uncertainty before all of this cools down. And this brings us to one of the key indicators that we've been watching, and that is home builders. We've talked about home builders being an exceptional leading indicator of the market that we're watching very closely in a recent video. Some of you pointed out that home builders are particularly sensitive to Donald Trump's tariffs, which makes them an even more relevant indicator to be watching today. Home builders really began to underperform following Donald Trump's election, as investors priced in the impact that potential tariffs on lumber coming coming from Canada would have on the home building sector in the US. If we add the S&P 500, we see that this underperformance foresaw the decline in the stock market ahead of time. One of the things that we wanted to see on a stock market bounce was a big outperformance in home builders, which would suggest that concerns around tariffs are dissipating. As you can see, we haven't really seen that on this bounce. If anything, home builders have continued to underperform despite the recent stock market rally. So to us, this is not telling us that the concerns that initially led to this correction happening have all of a sudden dissipated in the recent bounce. And it does make us a little bit more skeptical of just how much lasting power this most recent rally is going to have in the short term. And that brings us to the third key risk that we're watching on the market right now. And this is something that's flying under the radar for most investors because of all of the noise around tariffs. And this is what is happening on technology stocks. Just for some context, the top 10 stocks in the S&P 500 currently make up 37% of the index. The average going back to 1990 has been around 24%. So we are in a situation where a few extremely large technology companies are making up a disproportionate part of the market. And we are seeing some evidence that this is potentially at risk of unwinding right now, at least partially. This is a chart showing us the technology sector's performance against the S&P 500 index. And while the performance of tech stocks in 2023 and the beginning of 2024 was extremely impressive, since then it's been slowly rolling over. If we add key moving averages, we see that the overall trend has shifted from being upwards to generally being downwards. The last time that we saw something like this was in the first half of 2022 right here. So we think one of the risks in today's market is actually that we see a steeper underperformance of technology stocks relative to the S&P 500. Basically seeing this chart retrace at least part of the move up that it made in the first half of 2023. Now, if this happens, it wouldn't be such great news for the overall US stock market stability. If we add the S&P 500 index on top of this, we see that the overall US stock market tends to be correlated to the technology sector's performance. And most of the times where the technology sector underperformed, the overall stock market also underperformed. Now, if we do see this kind of unwind, by the way, it could lead to a major buying opportunity on technology stocks at cheaper prices. So that's how we're seeing the current stock market rally. Overall, this is a buying opportunity for stocks, but seeing another big dip down and a generally choppy market over the next month would really not surprise us. So at Bravos Research, currently we have a more diversified portfolio of trades. We have exposure to gold, we have exposure to China, energy companies, utility companies. All of these things that I'm mentioning have been extremely resilient in the recent sell-off and could continue to perform well in the short term. We still have exposure to US stocks, of course, but we're being a lot more selective in the names that we're adding to our list. The goal for us in 2025 is to achieve a similar or even superior performance to the one we had in 2024, where we had a total of 85 winning trades at a 16% gain each, and with very limited losses, making us outperform the S&P 500 by a significant margin. I teach you everything I know about trading on our website, so if you want to learn how to trade and get access to all of our trade ideas in the process, make sure you're subscribed to our service at Bravos Research.